¿Qué tal? Bienvenidos. Buena tarde a todos nuestros seguidores en nuestra fanpage de Facebook, @ulagrancoarmenia, y a través de nuestro canal de YouTube, que a esta hora están conectados con nosotros. Como siempre, tenemos invitados muy especiales y temáticas que interesan a toda la opinión pública en general, alrededor de temas que son de mucho interés y mucha practicidad en la vida diaria, en la vida profesional, en la vida personal, en la vida familiar, etcétera. Hoy corresponde al área de Derecho y Ciencias Políticas y Sociales y su facultad. Y tenemos una invitada muy, pero muy especial en el día de hoy. Vamos a hablar sobre Language Across the Curriculum. La invitada es la doctora Esperanza Buitrago Díaz, investigadora senior en el Centro de Tributación de Maastricht de la Universidad de Maastricht, abogada de la Universidad de la Sabana, doctorado en Derecho Tributario y Administrativo de la Universidad de Salamanca, alumna del Instituto Max Planck de Derecho, Fiscal y Finanzas Públicas en Alemania. Pero antes de darle entrada a nuestra invitada especial, pues le doy la bienvenida al coordinador de investigaciones de la Facultad de Derecho y Ciencias Políticas y Sociales, doctor Figueredo. ¿Qué tal? Un abrazo. Gerardo Figueredo, de la Facultad de Derecho y Ciencias Políticas. Bienvenido, buena tarde.
Muy buenas tardes, Juan. ¿Cómo está? Muchísimas gracias por la presentación, por la apertura de este espacio. Nos acompaña la doctora Esperanza Buitrago. Now, since this moment, we switch the language. Dr. Buitrago works at the Maastricht Center for Taxation at Maastricht University. Over the last years, her focus is international taxation. And his main knowledge is now in tax law, banking law, LMs on tax. And she was a visitor professor in China, Colombia, Argentina, Germany, whatever. For me, it's a pleasure here in Armenia with you share this space about this important topic. Pardon. Can you hear me?
Yes, thank you, Gerardo. It's a pleasure to be today with you and to have the honor to be invited by the Universidad Gran Colombia in Armenia. I thought it was going to be difficult to talk from the Netherlands to Armenia when we had now the winter starting. And we decided to have this background of how the courtyard of our law faculty looks like in spring times. Well, thank you for having me today with you.
Okay, it's full grain. Full grain. Okay. Will you see the slides?
Yes.
Yes.
I have the slides on. So if you allow me, then we could start.
Okay. Start, please.
The floor is Thank you. Well, thank you again for this invitation, and it's a pleasure for me to share with you and all the participants some ideas about this new topic on international taxation. And I choose a name that I think is close to your hearts because it's the Chronicle of a Debt Foretold. The Chronicle of a Debt Foretold is the heading of a book published by Gabriel Garcia Marquez in 1981. And as you all know, the main question of the work is how the death of Santiago Nazar was widely foreseen, but no one was able or willing to stop it. The book presents the circumstances surrounding the death and explores the morality of the village collective responsibility in the murder of Santiago Nazar. And then with this introduction, you may be thinking, and what does it have to do with the principal purpose test in tax treaties? So, what we are going to do is we're going to dive into this topic through this agenda. We're going to see what is that clause of the principal purpose test, which is an anti-avoidance rule that has been introduced in some tax treaties. We are going to explore who is going to die and why it has been foretold that this is going to happen. And more important, we are also going to see how. So, kind of literary reflection of something what is happening in the world of international taxation. So, with this in mind, with these three steps in mind, let me then begin the journey presenting you the clause we are going to talk about. The principal purpose test in Article 29, paragraph 9 of the OECD Model Tax Convention from 2017. When I refer to a model of the OECD, we are talking about a model that the OECD recommends member countries and even non-member countries to follow when they negotiate tax treaties. But in addition to recommendations to follow the provisions of their models, they also recommend commentaries that they release via recommendations of that models. So there are model conventions on one hand, commentaries on the other, and that models can be used by countries when they negotiate the tax treaty. And later on, the OECD expectation is that whenever they use their model, the interpretation also follows what they are saying in the OECD commentaries. And we are talking about written materials that are published and that are subject to changes over time, and that changes are also published. And this work comes already for a number of years since the OECD took over the works of the European Organization for the Cooperation and Development, that also took over from the League of Nations that started the works in 1920s or something around that time, at the request of the International Chamber of Commerce. So it's a long evolution in a time in which no anti-avoidance rule was introduced in the model convention. So if you if you think about it, from the 1920s just until 2017, almost 100 years later, then we get a general anti-avoidance rule proposed for tax treaties that are negotiated between contracting parties, whoever they are, and commentaries that are addressed to them. Why 100 years need to pass to have such a clause? Why do we need it? What does the clause says? So as you see it on the screen, it is saying that now, notwithstanding the other provision of this convention, a benefit under this convention shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provision of this convention. So that means, in plain terms, if you are working on a tax planning strategy and one of the reasons is a tax motive, the idea of reaching a tax benefit, depending on the facts and circumstances, you might be also confronted with a situation in which the treaty benefits are not going to be granted to you if the tax authorities establish that that planning, that specific arrangement, is not in accordance with the object and purpose of the relevant provisions of this convention. 100 years to get to this clause. Why? Who is going to die here? So let's have a look at the who and the why. There is something which, and I'm not sure if everyone is familiar with taxation and with investment treaties, but it's very common that in the field of investment treaties and of tax treaties, there is a phenomena called treaty chopping. Treaty chopping, as you see it on the screen on a definition of Ruben Avillona, is a label for a phenomenon where a person chops into an otherwise unavailable treaty through complicated structures. Let's approach one to see how this works. So I'm going just to make it very simple, explaining an example that the OECD itself brings in one of its works on the treaty chopping. So what happens in this example is that we have, as you see it on the screen, a company that is this rectangle in country CI, that is Cayman Islands. There is a company resident in the Cayman Islands that licenses intellectual property to company C in country SA, that is South Africa. And in this scenario, so if there is a license of the IP, what you expect, of course, there is going to be a payment from company C to company A. Let's assume the payment is 100 and country SA applies a withholding tax that is of 20%. So from on this payment that C makes to A, country A will withhold, will keep 20%. Without a tax treaty, that is what normally would happen to that payments abroad, unless the law doesn't really apply any taxation or is exempt or well, whatever. But in principle, let's assume this is the case. Then what happens then is that okay, normally South Africa will collect this 20% tax, but then the Cayman Island company decides to interpose a company in another country. Let's assume the Netherlands. I put a year 2010 on purpose. And then the Cayman Island company licenses the IP to the Dutch company. And the Dutch company is going to be now the one that also sublicense the IP to company C in South Africa. But then there is a tax treaty between the Netherlands and South Africa. And as a consequence of the treaty, an application of Article 12 of the tax treaty, country SA, South Africa, won't be able to apply the withholding tax due to the allocation rule of the royalties to the country of residence where the payments are made to. So to B company is to B, that is the residence is resident in the Netherlands, and then the expectation would be according to the treaty, that the royalties were going to be taxed in country B and not in country C. But what happened in practice was that until some years ago, until maybe 2, 3 years ago, the Netherlands didn't tax any inbound or outbound royalties. So that payments were going to flow basically to the Netherlands, not taxed in South Africa because of the treaty, and then pass to the Cayman Island, again, not taxed. And there will be basically not taxed, maybe not anywhere. And by interposing this company, then they achieve that saving. So that is the phenomena that we are talking about. And why were or are tax administrations concerned about it? Is it only because the payment flow free of taxes through the Netherlands to a tax haven? Normally, it was also not only that, but that was also important. But normally, tax administrations were very disappointed in the trunk in this kind of treaty chopping structures, because what would happen normally, or what they found out, is that companies like Company B lacked maybe personnel. They were registered in a lawyer's office or in the accountant's office. So the only thing that they had was a letter box in a building in which this lawyer or this accountant was receiving the correspondence. He was taking care of whatever correspondence that took place. All the money flew through a bank account that was in that country on the name of that company, but there were no other employees, there were no other premises, and there was no activity in the intermediary country. And this is what tax administration decided: we are going to end up this story. So who is going to die? Now you know, right? Then let's see what efforts have countries made to tackle that phenomena. Well, I already explained you this. It could be these treaty choppings could be abusive. There are also cases in which treaty choppings are not abusive. If time allows, I explain you some cases in which it is not abusive. But for so far, so this concept of letter companies or of shell companies. These shell companies are those companies that only have a name, but are in the conditions in which I explained you before: no assets, no personnel, nothing, no substance in the transactions, etc. And conduit companies might be companies that do have employees, substance, and so on, but for specific transactions, they are only helping to route the money. So the specific transaction can be challenged. Um, then we're going to speak about what have countries done in order to prevent this phenomenon. So the OECD and also the United Nations have been concerned about this phenomena already for a number of years. And what they tried to do was to introduce a specific anti avoidance rule that is called the beneficial owner. And that clause was introduced in specific articles of the Model Tax Convention, not in all types of income, but in specific cases that the model bring, like the royalties, dividends, interest. The United Nations have a different approach to the beneficial owner, and they also apply to other clauses. But in principle, as I mentioned, is a special anti-abuse rule, different to the one we are talking, that is the principal purpose test, that is a general anti-avoidance rule. And then, as you see on the screen, they come already for some time trying to trying to stop that phenomena that they have found in practice, with different reports, making the tax administrations more aware of what is happening, introducing some commentaries to the model tax conventions, and, as I said, the specific laws. But now they came out also with the idea that the clause had to be introduced in the text of the tax treaties. Because something which they tried already since 2003 and which they call the guiding principle has not been very helpful to combat that kind of practices. So they say, okay, so far, well, the tools that we have to fight this phenomena so are the specific anti-avoidance rule, the application, also the OECD initially rejected the possibility to apply domestic anti-avoidance rules to tax treaties, but in 2003 they changed that idea and they recommend tax administrations and judges to use their domestic anti-avoidance rule to tackle this phenomena whenever they find it, and also to apply their judicial doctrines against abuse whenever it is necessary. And if they feel that they don't have sufficient tools with that, sufficient elements to tackle the situation, then they could use the guiding principle of the commentaries. But now they say, okay, if that is not enough, now let's invite countries to introduce that clause in the tax treaties. And the last resource things that they can do, if definitely this doesn't help the tax administration of the judges, is okay, let's renegotiate the treaty. But renegotiating treaties is something which takes some time, so it takes some effort. So actually, there is a better proposal for that, and is that via a multilateral agreement, the clause is introduced in all tax treaties that a country decide to include under its scope, and that is called the multilateral instrument. So as you see, is the death of the foretold death, no, coming with a number of provisions, and finally with one that is going to be the very powerful one. In this evolution that I just told you about, and that since 2003 marks a point in time in which they say definitely we have to combat this treaty chopping and whatever abuse that is coming from the practices of taxpayers. So addressing tax avoidance could be then via the tax conventions with the specific anti-avoidance rules, with the general anti-avoidance rules called PPT, via the requirements for treaty entitlement, via the commentaries that the OECD releases, introducing the guiding principle, or via the domestic and general and specific anti-avoidance rules, or the judicial doctrines that are part of domestic law. As you see, the toolkit has grown quite big over time. And it grew more when the G20 and the OECD decided to support that measures that were worked by the OECD through what is called the BEPS project via different actions. And one of those actions is Action 6 that you see there, preventing tax treaty abuse. And it's a part of what they call minimum standards of the OECD inclusive framework. That is a global forum of the OECD. Then it gives that action 6 gives some choices for countries. So it tells the country, if you're a member of the inclusive framework, then you will have some obligations. And one obligation is this one, because countries that are there have to comply with that minimum standards. And then either they adopt that clause that we presenting at the beginning alone, or they do it alternatively with a simplified limitation of benefits provisions, or they adopt a detailed limitation of benefit clause supplemented by an anti-conduit arrangement mechanism. After that, basically, the implementation of the measures came via the multilateral convention to implement tax treaty related measures to prevent base erosion and profit shifting. And the number of actions came as part of this multilateral instrument, as you see in this convention. Part 3 dealing with treaty abuse, and Part 4 with avoidance of the permanent establishment. But basically, all these provisions are around that, and with measures to be able to combat profit shifting and to try to improve the resolution of disputes between taxpayers and the tax administrations in the ways that are set by the tax treaties and the multilateral instrument. Um, so basically, after BEPS, we will have not soft law but hard law in whatever countries that decide to follow the 2017 version of the OECD model tax conventions. Then, actually, we get um, this scenario in which the OECD is saying, okay, now it's also going to be the end of avoidance, with a small issue that is that no one knows what is avoidance, but the OECD is going to deal with it, is going to fight it, and is going to fight it with the instruments I just told you. And in order to provide the interpreter with some tools to combat that phenomena, then now we will have a preamble in the terms we are going to discuss soon, and the change of the title of the convention, the guiding principle that mirrors basically the clause, the principal purpose test I told you about. Of course, the tightening of the entitlement to treaty benefits, some specific provisions on the relief methods in the tax treaties, and also the possibility to subject this kind of disputes to mutual agreement procedures between tax administrations and eventually to arbitration. Um, so the question that you might be wondering now is whether these measures that comes from hard law and from soft law are the same. Are they necessary? So let's have a look at them. So what the guiding principle tell us is that the benefits of a total taxation convention should not be available where a main purpose for entering into certain transaction or arrangement was to secure a more favorable tax position, and obtaining that more favorable treatment in these circumstances would be contrary to the object and purpose of the relevant provisions. Um, the PPT bring us this clause is the one I told you at the beginning. It only has it has um, a difference, no? That is, the consequences are the same if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purposes of any arrangement or transaction. So, from that clause, a number of questions emerge. Does it mean that you cannot benefit of a tax advantage anyhow via a tax treaty? An advantage that was granted by the treaty? Can you think about it? Or definitely the tax treaties are only going to be to put a frame around, put them beautiful in your office, and that's it. Why? Why taxation cannot be one of the elements that a taxpayer considers when deciding where to invest or how to invest or what to do in a specific circumstance? Then the rule is telling us if this is if tax is one of the main elements, one of the principal purposes, careful, because you may not be entitled to get the benefits of the treaties, meaning that South African company that in principle had to exempt the income maybe will not never the company will never get the refund if the tax authorities consider that this company in the Netherlands was interposed with the main purpose of getting that benefit against the object and purpose of the relevant provisions of the convention. And it's a quite powerful clause because basically what is telling the interpreter, either the tax administration or the judge, is that they are not bound by the text of the law. In those circumstances in which the object and purpose of the provision has been and the treaty has been defeated by the intention of the taxpayer, they are not bound by the treaty and they are not obliged to grant him the treaty benefits. When? When it is reasonable to conclude that that is against the object and purpose of the treaty. But the clause is also it's also important there to say that this reasonability that the clause brings it's very important to consider because it also indicates expressly that all the evidence must be weighed to determine whether the conclusion is reasonable or not, and that they have to consider all the facts and circumstances of the case. And the OECD brings a number of cases in which, by a number of examples, in which they are saying, okay, in all these examples, 11 out of 13 examples that they bring, in 11 examples, it's reasonable to conclude that the taxpayer intent was not to defeat the treaty, and therefore the treaty spirit, no, the object and purpose of the provisions, and therefore is entitled to the benefits of the treaty. One of the things that is that for tax lawyers, no, and for experts is a little bit shocking is the fact that the OECD believes that in these cases the the burden of proof is inverted. That is not no longer the tax administration that has to prove this intent of the taxpayer, but it's the taxpayer itself, the one that has to say, I am doing this because of this and not because I'm seeking to defeat the object and purpose of the treaty. And then These criteria have been used, no, in some cases, whether it is reasonable to get to that conclusions, and for the for the tax administration, sometimes with the information that they have, they believe this is reasonable to conclude that the treaty benefits have to be denied. But for instance, in this case of the Canadian Tax Court in Agro City versus Her Majesty the Queen, the court, the Canadian Tax Court, concluded that what the tax administration was doing was not reasonable, and that the inversion of the burden of proof could not really come from the circumstances, and that from all the evidence that the taxpayer brought, they didn't conclude that there was a sham. That was what the tax administration was claiming to deny the treaty benefits. Instead, they concluded that the agreements that the Barbados company and the Canadian company signed were agreements that were real, that other taxpayers would have entered in the same in order to achieve what they wanted to do in the specific case. So the criteria that the OECD are bringing are not, let's say, universally accepted. But the OECD, anyway, it's very important that they are trying to be fair now in their proposal, and then they say that a purpose will not be a principal purpose when it is reasonable to conclude, having regard to all relevance and circumstances, that obtaining that benefit was not a principal consideration and would not have justified entering into any arrangement or transaction that has a loan or together with other transactions resulted in that benefit. So reasonability plays an important role, and it brings us then to the second, or to another element of the definition, that is that obtaining that benefit was one of the principal purposes of any arrangement of transaction. What happens then if I have a commercial reason, if I have a business purpose and a tax purpose at the same time? Does it mean that the tax administration still can, if I have a valid reason, if I have a reason to have an enterprise, a manufacturer company in Panama or in Hong Kong or wherever, but I do have the valid reason. I have there the company. The activities are real. Can they tell me that instead of doing that in Panama, I should have done that via Venezuela or via Peru or via Mexico? Because then I would end up paying more taxes. And then the OECD brings some examples. I'm going to try to be short now because I think my time is over and Gerardo might be suffering with me exceeding my time. But in this case that we have, well, I'm going to jump to a British case. This one. One of the main purposes is also in the British domestic tax law. And what happened in this case, it was that there was a debt that was transferred from a company in the Cayman Island to another company that is called Jeffers I think in Ireland also, and that Jeffers transferred that debt to Ireland, and the debt was finally paid in Ireland, but there were still some interest to be collected from a company in the UK. And when they made the agreement for that transfer to BLM, for the transfer of the debt, knowing that the interest still has to be paid, so they knew that between the Cayman Island and the UK, there was no tax treaty, but between Ireland and the UK, there is a tax treaty. And then in this case, the tax administration was arguing that one of the reasons for entering, one of the main purposes of such arrangement was to benefit of the treaty between the United Kingdom and Ireland. And what the court concluded in this case was that it was true that the BLM, when they got the debt, no, they knew that they would benefit from the treaty. But the court said, knowing that one has the benefit doesn't mean that this was the purpose of the assignment. Determining an intent on the primary objective of taking the benefit of the treaty requires more than simply selling the debt claim directly at a market price. The tax administration need to look into all the evidence, facts and circumstances of the case, and it is not sufficient to say that there is one benefit there and that the taxpayer was aware of it, but the tax administration has the burden of proof to say why the object and purpose was not complied, and that was not achieved in this case. And then this brings us then to the last element of the definition, that is, unless it is established that granting the benefits in these circumstances would be in accordance with the object and purpose of the relevant provisions of the convention. And then the question is, okay, what is the purpose of the convention? What is that of the object and the purpose when we are talking about tax treaties? And the OECD, as I told you before, has included some tools that the interpreter may use as this preamble that includes these purposes expressly, because it says that the treaty is to further develop economic relationship between the contracting states, to enhance cooperation, and they further the development of economic relationship through the elimination of double taxation of taxes on income and capital, without creating opportunities for the victim, the treaty shopping, no? Indirectly benefiting residents of third states, non-taxation or reduced taxation through tax evasion and avoidance. Problem is, as I told you before, it's not yet very clear what they mean with tax avoidance. And if all cases in which a taxpayer ends up with a non-taxation in one of the countries is also going to be falling under this provision, getting a denial of benefits. So but it's clear here that they want to combat treaty shopping. It's clear also that they want to have kind of healthy trade, no? Not that you expand around the world, but via these letterbox companies, they want to have bona fide exchanges of goods and services, and that is pointed in the commentaries also. And the question is, how far can they get in a specific case in which they tell the taxpayer, you are going against the object and purpose of the convention, and therefore I am denying you the treaty benefits? Is it really necessary to have an anti-avoidance rule such as the one we are discussing? Some authors, like Michael Lang, for instance, from Vienna University, he claims that it is not necessary to have such clauses because it is already in the object and the purpose of the law, no, to bring the interpreter this idea that he can fight avoidance whenever he sees it. And an example that comes from Latin America, and I think I will stop after this one, is it's coming from Argentina. The Supreme Court of Argentina had this situation that you see on screen. That is the case of a parent company called Molinos Rio de la Plata in Argentina. It's a resident of Argentina, and that company held an equity participation in a second tier operating subsidiaries residents of Peru and Uruguay. And without a tax treaty between Argentina, Peru, and Uruguay, the dividends that flow from each country would have been taxed by Argentinian income tax. And that came already for a number of years, and with a treaty that was signed in 1985. Um, but then what happened was that in 2002, Chile enacted what is called the investment platform companies, where such companies were not taxed on foreign source income tax. So, on foreign income, meaning that the Molinos holding in Uruguay would receive the dividends from Peru and from Uruguay, and those will not be taxed in Chile. But then there was a treaty between Argentina and Chile. And what happened then, there was this clause that establishes that dividends and shares in the profits of enterprises, including returns or surpluses of cooperatives, shall be taxable only in the contracting state where the enterprise distributing them is domiciled. So if we look here, then the question is in the column of the right, who is distributing the dividends when they flow from Chile to Argentina? Molinos Holding from Chile. Who is entitled to the taxation of those under the tax treaty between Argentina and Chile according to the treaty text? Chile. But the problem is that those were not taxed in Chile. So the Supreme Court found that outrageous. And they decided that it was not possible to grant the benefits of the treaty to in this situation because they say it is against the object and purpose of the convention. And they said, if you look at the paragraph, if you look at the title of the convention, if you look at the treaty, what you conclude is that this treaty was designed in order to prevent double taxation. But in this case, what happens is that the ultimate result, is double non-taxation. And therefore, the treaty benefits cannot be granted because that was not the intention of the treaty. So, as you see, thinking of object and purpose of a treaty can be a bit tricky. And thinking of other judicial doctrines, so in other cases, judges have also concluded that anti-avoidance rules are not necessary. For instance, in this case of Austria NAG, the Administrative Court of Austria also concluded that a state has the right to protect itself against an unjustified exploitation of tax benefits provided for in the convention. And extended jurisprudence also coming in other cases have been recognized that a recipient of the income in cases of dividends, interest, and royalties, the recipient was not was not really the recipient of the income, not the real one, not the final one, not on its own right, because it was a nominee, or because that company didn't have any right on that income, and the only thing they were going to do was to transfer it abroad. And that was recognized initially for the beneficial owner without having the beneficial owner. And in the case of Argentina, in the case we analyze, the treaty didn't have a provision for the beneficial owner. But the court said, well, in this case, the Chilean companies with such a investment platform companies, they are also not the beneficial owners of the dividends. And the treaty didn't have a dividend provision. Sorry, an beneficial owner provision. And of course, you can imagine that there is a potential for conflict, because if you do not have an anti-avoidance rule in the treaty provision, and then the tax administration claims that they see avoidance in your transaction, and that they want to apply the domestic anti-avoidance rule to that, you say, hey, sorry, but that is a treaty. How do you dare to do that? Right? You will tell that. Don't do that because the law doesn't allow you to. It is not written in the text of the treaty. So how can you come with domestic law to refuse the treaty benefits? And then, of course, that creates a conflict. Because one thing is what the OECD is thinking, and another thing is what is the practice also in every country. Sometimes judges say, well, this is a beautiful theory, OECD, but I'm sorry, I am bound by the text of the treaty, because treaties are also clear that the main rule of interpretation, the beginning of everything and the end of everything, is the text of the convention. From where do I get that I apply the intention when I cannot find anywhere in the treaty that I can look into that? So as you can see, it's a conflict between the subjective element, of finding the object and purpose of a treaty and of a provision, and the text of the provision that is granting the provision whenever certain circumstances are met. Countries like the Netherlands, for instance, have been very clear in their case law on vrouwsleges that the domestic anti-abuse rules cannot be applied, are not applicable to tax treaties so far. And there are also other things, that comes in regard to conflict, but I think it's enough to exemplify, to give example of I would say, there was a foretold death, and it's going to be the one of the treaty chopping with powerful instruments now, with powerful tools. And I guess you may have questions, comments.
Yes, one of them in the comments right here in the video, and two appreciations. One of them is the rule of law is disappearing right now about this topic. We are in a regressive appreciation of the administrative or judicial operator.
Is the participant allowed to express himself in the conference, or is it only via the chat?
It's via the chat.
Okay, but I cannot see the chat.
Okay. But it's in this topic. It's about the rule of law is disappearing. It's like disappearing because taxation is all. is the principal purpose. And in terms of guilty, the taxpayer is guilty of tax avoidance, even if he proved the gains.
So I believe, according to the person who wrote this comment, which is very welcome, and I'm going to reply on that, but I believe the victim of the PPT is the taxpayer, not the treaty shopping.
Thanks a lot, Esperanza.
It is certainly it's certainly a very important topic, and in some of the cases that I have analyzed, the court is saying, hey, tax administration, you are claiming that this taxpayer was interposing a letterbox company or a shell company or a conduit company, but you didn't demonstrate that. So a very important element to make sure that the rule of law prevails is to have that evidence that what you are doing via that interposed company really follows a business reason, that there is a commercial reason. Because if the tax administration is able to demonstrate that you do not have any assets, any premises, no personal, no activities, but only you are in an office of a lawyer, of an accountant, or of a nominee, and the only thing that that company does is to pass income to wherever, just to benefit from the treaty, of course the tax administration is entitled, and it is their duty to follow that and to deny the benefits. But if you taxpayer really have the commercial reason, the business reason behind, it is the rule of law is giving you also the elements. You have all the elements to defend yourself. And the burden of proof to say that it is not as you are saying, it is from the tax administration. What you would have to check is whether your country allows such an inversion of the burden of proof in the law. And you will have to fight that. I will fight that with hands and feet before constitutional courts. Because the constitutional court is the one that at the end in a country would be able to say no to that due process. But if no one say anything, at the end, of course, you will be confronted with a monster. And you will be confronted not only with already the high burden of compliance that enterprises have, but to more in the specific cases to demonstrate that what you are doing is not against the object and the purpose of the treaty, and that what that you are doing is contributing to trust in trade, and not that you are going against that with whatever artificial arrangements.
Thank you, Esperanza. This is a really, really complicated item. Professor Rodrigo Polanco from World Trade Institute says international law and taxation is like a lasagna. Level, add another level, add another level, another complexity, and it's between public and private law. Thanks, Esperanza.
Well, my pleasure. I don't know if there are more questions or if this is the end.
This is the end.
Okay, so I would like to thank you again and to thank all the participants for the time and for the comments and the questions. Yeah, I would really like to enjoy that lasagna, but in an Italian restaurant,
Okay.
in one of those delicious Colombian restaurants, no, which are very nice always. Well, I can only open the invitation for the people interested in following these topics to join us also at Maastricht University. We have our Maastricht Tax Talks for Latin America in Spanish. I normally forward them to Gerardo. Once in a while, we announce them also on LinkedIn. And it will be my pleasure to be in contact to whoever also want to follow up on these topics. Thank you very much.
Thank you. Muchísimas gracias, Esperanza. Hasta pronto.
Bueno, hasta pronto. Un placer
Hasta
y hasta
pronto.
una próxima
Listo.
oportunidad.
Listo.
Felicidades.
Muchísimas gracias. Hasta luego.
Bueno, adiós.
Universidad de la Gran Colombia, una experiencia de vida.
Prepárate y deja huella de tu aporte al mundo. Somos tu mejor opción. Estamos alineados con la cuarta revolución industrial, optimizando nuestros procesos mediante la innovación, el uso de nuevas tecnologías y el máximo aprovechamiento de la información. Somos Universidad Verde y como tal propiciamos una cultura de sostenibilidad ambiental en toda nuestra dinámica institucional. Contamos con más de 12.000 graduados gran colombianos, ocupando cargos de liderazgo en la región y el país, dando testimonio de competitividad y formación integral. Constituimos una familia dinámica, interactiva, proactiva y en permanente evolución. Estamos preparados para garantizarte continuidad, pertinencia, calidad y oportunidad en tu proceso de formación. Propiciamos oportunidades de movilidad internacional que favorezca el intercambio académico y cultural. Más que un proceso de formación, en la UGC Armenia no solo vas a estudiar, también vas a conocer amigos, reafirmarás tus talentos, asumirás retos, pondrás a prueba tus fortalezas y afrontarás nuevos desafíos. Ya estás muy cerca de hacer parte de la familia gran colombiana. Consulta nuestra oferta de programas académicos y escoge la carrera que más te apasione para que puedas cumplir tu sueño de ser el mejor profesional. Universidad de la Gran Colombia, seccional Armenia, formando los líderes de la región.